As I say, the equity markets seem to be wandering around a little bit this week. They weren't sure whether they believe the pandemic's going away or not. How do we find direction? What is the equity market looking for right now?
Great to be with you. Well, the market has done a lot of work. The market is up over 11 percentage points to date, and the average stock has actually done even more work. It's up over 15 percentage points. But a lot has been baked into the markets. As you mentioned, the sentiment has been riding high, particularly as we're seeing these higher than anticipated earnings trajectory that's coming through. The direction remains the same, and that is an investor needs to be active and selective because change is the only constant. And while the reopening trade is not derailed, it's certainly delayed because of this uneven vaccination that's taken place. We're still extremely constructive on the equity markets longer term, and investors should be too.
You put your finger on it, I think, at least looking at this week. It looked like the reopening question was the big question on investors' minds. As you looked at equities, give us a sense of the upside and the downside there on reopening. What is the market pricing in terms of reopening?
Excellent question. Well, volatility has been brought back a little bit. And I think volatility is great because it offers investors opportunity to get into stocks that perhaps have gotten ahead of themselves. And we certainly saw that within the cyclical areas of the market, the energy side of the equation and others within the industrial space. I think right now investors need to think about opportunities that perhaps have lagged, and there are plenty of those. I think it doesn't have to be a mutually exclusive story. You can play the growth, but you can do that alongside value trade. So an example of that could be within the healthcare space that continues to be a laggard and is at a discount to the market, and industrials where you actually had majority of the industries that continue to trail the overall sector. So there are a lot of different ways to, again, invest for the long term.
What about tech? I mean, tech was such a growth stock and it drove so much of the market for so long. It was the stay-at-home trade, as it were. Are there opportunities left in tech at this point?
Absolutely. Tech, you said it correctly, David, and that was the leader last year. We think that, again, within the secular plays of, if you think about this digital economy that's just starting out, one continues to demand higher security. One continues to transition to cloud computing. Companies that enable that along the food chain of semiconductors and cloud computing security will continue to benefit. We think there's a lot of opportunities within IT space right now. And again, many of the winners last year are actually laggards this year, which again presents an opportunity.
So you introduced me to a term I was not familiar with, the GARP, which is growth at a reasonable price. So you want growth, but you don't want to be overpriced. Does that mean some of the big tech, the mega tech, may be fully valued at this point, but there are others that are more toward the middle?
That's correct. Growth at a reasonable price, or GARP investment strategy, is what we employ in our focused growth strategy. And that is right down the middle, which is we want growth because that's how capital appreciation and wealth building works. But we don't want to pay too much for it, which is exactly why I mentioned areas of the market like healthcare that offer you within life science and tools a growth opportunity in excess of the market, earnings growth in excess of 16 percentage points, but at a discount to its fair value. Other areas of the market that offer growth that perhaps might be forgotten by the market is actually in the defensive areas of the market right now, like consumer staples, which has been a laggard year to date, but again, offers a reopening trade story within food, food distribution, and others as we think about restaurant reopening taking hold and those companies participating. So there are many ways to play growth, and there's growth in value and value in growth, and that's exactly what GARP sort of investment strategy stands for.
Yana, you mentioned earnings before. We're into the earnings season. We got a long way to go still, frankly. And as you said, boy, the earnings are coming in pretty strong. At the same time, how much of that was already priced in? Did people basically expect that? Because let's be frank, the economy does seem to be coming back pretty strong.
Excellent point. For context, the earnings are coming in right now for Q1 earnings. The expectations were when we started this earnings season were less than 15 percentage points growth year over year. We're now tracking twice that level, meaning earnings growth, if everything goes as expected, will be in excess of 31 percentage points, which is significantly higher. What's interesting, again, the question of what's priced in, is that less than half of companies that have reported better than anticipated earnings growth are going up, meaning less than 50% are actually moving on that better than expected earnings trajectory. So again, stock prices move on better than or worse rather than the absolute numbers. And again, while the earnings are coming in better, a lot has been priced in, which is why I think you need to be very valuation sensitive and very selective.
Do you also need to be government sensitive? I mean, let's be honest, a lot of the rebound that we're seeing is because of the government, whether it's the Fed through really accommodative monetary policy or the huge fiscal stimulus that has already come and maybe more still to come. As an investor in equities, how do you price that in? What do you do to protect yourself against possible changes?
Well, we have this saying that it's not politics, it's policies that certainly needs to be incorporated. And you're absolutely right. We've been in an environment where you've had extremely accommodative fiscal and monetary policies, which obviously have driven valuations significantly higher. And while that's not going away and actually continues to be that sort of a constant, one needs to take account of the fact that there are a lot of policy changes like higher corporate tax rate and many others that folks need to account for. And we're also in the midst of other things that are going on in the market, which obviously is higher inflationary pressures as the economy is reopening and things are heating up and demand is there, but supply shocks are creating sort of headaches for a lot of companies. Folks need to think about the input cost overall going higher and how is a company going to pass through those costs to the consumer to ensure that they remain as profitable as they were before all these changes take hold.